Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read the characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and only valid on a specific or identified date. Your results may vary by access in this webinar. You agree to hold the above harmless. Many losses you may incur as a result of the information discussed in the media identified above. By access to this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we will take your privacy very seriously, and we will not distribute or sell your information to anyone. All right, great. Moving on. Just not in the mood. Where is our webinar page? There it is. Okay, now let's get caught up on chat. Okay, still the only thing I don't like about this thing, everything is better about this thing except I cannot, I have to do this to find chat. I can't just stay on the screen and have a floating chat box. Yes, it's not taking my license renewal on that. All right, next, let's see. So questions to start us off. Chrissy says she closed her SDS calls. Well, there's nothing, you know what, that wasn't a bad call, Chrissy, because, I mean, frankly, we did bounce, right? I mean, it depends when you called it, but we did bounce, and we just didn't bounce very hard, so we had a weak bounce, which means you might want to start thinking about getting back in. Oh, you had July calls. Still, July calls you should have closed and move into like September, like we're in on the short-term portfolio. Meanwhile, welcome everybody, and see if there are any good questions to start us off. Yellen, I don't know about Yellen, but Obama was talking about something. I mean, I wasn't paying attention to what he was saying because we would be doing this. Okay, and nobody's got a question. Fantastic, other than Chrissy complaining about her SDSs. All right, so let's see how things look. I was noticing something right before we started this thing that's very creepy. So the S&P's having not a very good day. We're flat. The Russell's flat. If we look at all the charts at once, I guess we'll see pretty much everybody's flat. Well, that's terrible, though. We had a terrible day yesterday, and now we're flat. That's not recovering. What we did is like weekly bounce, and now we're back to flatlining. That's not cool. The dollar's punching up a little bit. Gold is flat, pretty much at 11.75. Silver. Look at this nuttiness in silver. All the way. Son of a bitch! Did I miss that? You guys know I like 15.50 for an entry, right? That's where I like to enter it, but I wasn't paying attention. 15.50, and we popped all the way to 15.80. That's so much money. It's $50 per penny. That's like, I don't know, it's like a $2,000 move. Son of a bitch. That annoys me more than the gasoline. This is freaking! I can't believe we missed this. Who was not paying attention to silver? 10.40. Damn. Somebody could have said something. I'm looking at lots of stuff. I can't watch these things all the time. Oil has been very nice off 58. Came right back up to 59. It's been very good. Brent also moving along up 1%. So people, and again, we're coming into the holiday weekend, so of course everybody's excited. Gasoline. Here's gasoline. Gasoline has been on fire. It came up from 2, touched 205. Now we're drifting around 204. As I said this morning, going long off that 204 line is a good play, and look what happened. You know, look, once we got out of 2025, or I did anyway this morning, because I just was like, we have this really, here's where I got out. Now you can see why I got out of 2025. We had a huge run, and then it started looking iffy. So I said, oh, get out. Now, I wanted to get in at 2, but this is the 8:30. This is when I'm working. I'm like really doing a lot of stuff when I'm writing, so I just didn't have the time to watch it. It got away, unfortunately. Went up to 204. But once it's over 204, obviously, if it's consolidating there and you want to be bullish, then you just play it with a tight stop for a move up. And we got to 205, but now we're back down. But this 204 line so far is holding, which means it's still probably looking to move higher. Of course, it's a completely freaky day, so it's not that easy to make any kind of call. But if you want to stay bullish, and especially if you're like crying because you got out at 205, 202.50 like I was, you might want to get in. Yeah. Honestly, though, on the whole, I mean, I had it's a $3,150 profit off what I was playing yesterday. And down here, I had a $2,000 loss down here yesterday. The same stocks. I had 4 contracts that were right about $2. And so here, they were down $2,000. So when they go up $3,000, it's 5,000. I mean, the account's plus 5,000 on that one in a day move. So I took it off the table. I mean, I want to be greedy. It's fun to be greedy, but I just, I don't know. At 202.5, it looked a little bit weak, and I said, "The hell with it. Let's take the money over here." So that was that move. But I mean, I don't know. It's weird. It's weird to make $3,000 in the morning and then go, "Oh, I wish I hadn't done that." But here's what I thought was strange. Check this out. No questions. Okay, good. I'll just keep rambling then. Let's see. Look at this. First of all, VIX is flying up. Okay, this is kind of live. I think they're probably. Oh no, sorry, 5. 5 minutes short. Okay. The VIX is flying up. I would say these Finviz things are. Well, it says 111. It is 111, but this isn't 111 charts. These are probably about at least 10, maybe 15 minutes delayed, but still good enough. Look at this weirdness, though, that's going on. Look at hogs. Hogs, corn, soybeans again, oats, rice, soybeans some more. Why do they trade every kind of soybean oil, soybean? Wouldn't it all be soybeans? Wheat, canola, not cocoa though, cotton, orange juice, not having a good day, coffee suddenly flying. We have a long on Joe in one of our portfolios. That's the coffee ETF, JO. Lumber, Well, obviously nobody's building anything, so you're not going to have lumber. Sugar flying. What the hell? What on earth is going on here? Okay, we must have missed some kind of agricultural report or something. That's not good. Cattle, and look at the weird thing, cattle's down here and hogs are up here. What would kill cattle while raising feed prices? Maybe because if the feed gets expensive, they start killing more cows and then puts them on the market? That's all I can think of on that. And what the hell? What caused this? So where's the dollar? The dollar. Gosh, you can't find anything. I don't use this view very much because you can't find stuff. 30 notes taken off. Here's the dollar. And the dollar shot up. It didn't go down, so that's not why these things change like that. It's a very strange thing. There must be, to come up with a narrative for this, I would have to say, through the feeder cattle, it just seems to me that there must have been a bad crop report which makes the price of all the basic crops go up, while at the same time the expectation would be, well, it's now expensive. Now, since food costs get expensive, the farmers make a decision to say, okay, I'm going to kill my cows early this year because it's getting expensive to feed them, which makes sense. It's very rational because for the farmers, it's a weight ratio thing. So your spring cows are X grown by July. Your newborn cows from the spring are X grown by July, and you expect to maybe get another 3 weeks out of them. But that's based on your input cost of feeding the cows for the next 3 weeks versus how much the cows are going to grow over the next 3 weeks. There's a certain point they hit. You can practically chart it at which the food cost for keeping the cow alive isn't worth the additional money you think you're going to get out of the cow. So that's possibly why, but I don't know because I haven't read the report yet. I can't figure out what the hell this is. But that's what makes sense to me at the moment. I mean, this is huge. All these things spiking at once is so weird. And it came right at noon. So there had to be like a report that happened at noon that caused this. And really, I mean, really drastic sudden changes. So we'll see where that all settles out. It is not obviously based on the dollar doing something, though. This is something that happened in that sector. So crazy stuff going on. Nikkei doing weird things also, all of a sudden perking up a little bit. Our indexes, though, not really perky. I mean, nothing very exciting going on there. Here's Nikkei, only a 2027. Looks more. That chart's a really magnified chart. It looks actually more perky than it is. It's just this little thing right here from bottoming out at 20,200. I don't like the Nikkei long here. 20,000 is big support. I think we're kind of stuck between 20,000 and 20,400 until it breaks. And I think if it's going to break, it'll break to the downside. Oh, I can make that smaller. No, not much. Let's see if we can find a different Nikkei chart. Okay. Oh, really? Just because I'm doing a little fine. There we go. All right, so where are we? In the big picture, this market is still, look at this thing. You think about it, it's like incredibly up. We're coming from 14,000 to 21,000. That's a 50% move. Hit 21,000 on the button. All right? So it's really just a patience thing because we're getting exactly the move we expect from 14,000 to 21,000. All right, and at 17.5, which is the halfway point, we already had some consolidation. All right, so this thing, you talk about following the 5% rule to the letter, okay? It's exactly what it's supposed to do. 3,500 points is half of the move to 21,000. You see the consolidation here before moving up to the next level. So here's the 25% line. But very little pullback. The 25% line has very little pullback, but an exact textbook pullback to a bit below 17,000. Then it takes off, so it's making a very, very strong 50% move. And now, just like this, we're going to probably have this consolidation and then a pullback. Okay, but this pullback should be twice as much as this one was. This one went from 18 to 16.5, which makes sense because it's 20% of the move. This one now is going to go at least that far, so we're talking about 1,500 points. So we should be back about 19.5 is what we're going to be looking for here. But I think we should get double that pullback, and double that pullback is going to be to 18 or 18.5, and 18.5 is right there. It's a 200-day moving average. Makes perfect sense. Okay, so what the 5% rule predicts is what is now the 200-day moving average, that we should pull back to that line. So that's what we're expecting to see on the Nikkei. That's roughly not 10%, it's like 7% below where we are now. And our bet is on EWG. Not EWG. EWJ we have a bet on. All right, so we're going to be looking for almost a 10% pullback here. So that's going to be about above 20. And that's going to take us, boom, right down here below that, really. But that's going to take us down here to this 200-day moving average, which, of course, makes sense, obviously. They're both going to test their 200-day moving average. But it's a slow burn. It's not going to be an exciting move or anything like that. All right. Questions? Anything about this? Let's see. Okay. Oh, thanks, Rob. Okay, so the USDA report came out at noon, and we can pretty much tell what it said then. It said crops are going to be more expensive, and El Nino and the drought in California and blah, 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 and all that. So nothing we don't expect because we're long on DBA for a reason, and it's doing exactly what it's supposed to do. It's funny because it's like this is something we predicted at the beginning of the year. DBA was one of our top inflation fighting trades of the year, at the beginning of the year. And it's like such an obvious thing that this would be what the report said, and now the report finally comes out, and it's just what we were saying about gold, actually. So I'm saying it's like so obvious to us, months in advance, years in advance, that something's going to happen, but people don't react until the report comes out. It's crazy. It's like, how did you not know that it was going to be a tough year for crops? How did you not see from California that prices were going to be going up? So great. So DBA is moving up too. That's good news. See how much it goes up is a question, but I'm pretty sure this will be a trend. It's not going to be something that's going to disappear. Oh, look at that. That's beautiful. Oh, that's what we wanted, was that breakout finally. Do we have DBA in the long-term portfolio? I don't remember. Ooh, 41.3 dropping. DBA. There's BA. Oh, we have Boeing? Oh, we have a spread. Good. I feel good about that. Didn't even know we had Boeing. That's because we only just bought it and I forgot. It takes me a long time to remember we have something. DBA. Oh, there we are. Good. Okay, DBA. So we have the January 21 calls. They can't be doing. Oh, yeah. They're doing like so. So we're we're in the right place. So we have the 21. This is a very conservative trade. Shame on me. We have the 21-23 bull call spread, and we sold aggressively the 22 puts. Now, I'll tell you something, because we took this trade on 4/14, all right, and DBA. Where was I just showing that? Here we go. We took this trade here on 4/14, the last time they came down, right? Because I put my foot down and said, oh, good, we got a chance to buy DBA cheap again. We hadn't had a chance. In March, it was low. I'm not sure what we did in March or why we had it. Maybe we cashed it out. We might have cashed it out at the end of March because this is when we did our cash out in long-term portfolio. So we may have cashed it out, and then I just sort of got the opportunity to get back in April. But either way, so for whatever reason, I put my foot down on this line, calling at the bottom, because fundamentally it was the bottom. I mean, we could see that from what was going on. And the trade is beautiful, though, because what we did is we bought the 21 calls for $1.99, sold these guys for 92, so about $1 on this thing, $1.07. And then we sold the 22 puts for $1 because we sold while it was going down. So in other words, on this downbeat, we sold the puts exactly when everybody was panicking. We made the sale. That's how you want to play the market. When you're a fundamental investor and you know what something's worth, you take advantage of these situations. You don't, this is the difference, because if you're a chart person, that was a bad chart. When you were looking at it that day or that time, let's go to Yahoo, I'll show you what I mean. Yahoo, DBA. I like this about Yahoo. It's one of the best features that you can do this with a chart. You go to a 1-month view, and then you can actually move it, so you can see what people were seeing at the time. So here's when did we say, April 14th? Okay, so here's April 14th. So I want to get the right day, so we look like that. This is the day, April 14th. All right. So here we are, and we made our DBA call this day. We hit 22. It's not like, I'm not catching a knife. I'm looking to see if the bottom that we put in over here and the bottom we put in over here is holding up. We came in here on the 9th. I didn't jump in on the 9th, not the 10th, not the 11th, not the 13th. Well, it was a weekend. And Monday, we were down around here almost again testing. So by Tuesday, though, I decided I said, now we want to get this. We still had a good price because of this drop. We still had a very good price on the puts because there was a lot of volatility. Honestly, well, what the heck was that? Why did that just happen? Oh, that was odd. So I must have touched something that made it happen. All right, so we're not, there you go. Oh, 16, sorry. Oh, it doesn't like being micromanaged like this. That's the problem. There we go. Can't go, well, whatever. There we go. Okay. So that's the view that we have. And that's the point at which we make our decision to buy. All right? We're just off the lows. We have a nice bit of volatility that increases the internal VIX of DBA. So all stocks have their own internal volatility. So when one stock is zigzagging up and down, the volatility of the LEAPs tends to go higher. Even though it doesn't know what the regular VIX is, it's in comparison to other stocks, it'll have a higher volatility. That's what drove these call prices up. Now, it wasn't extremely exciting, but we sold the $22 puts for $1. That's 5% of the price of DBA. But we felt very comfortable that that was a good bottom, and I'm happy to own DBA at that price. I'm happy to own an agricultural ETF at that price. So that's what led us to make this call. So the call was, we bought January 21 calls, $1 in the money from where it was then. We sold the 23 calls, which were $1 out of the money from where it was then. And we got net $1 on that, $1.07 actually on that. Then we offset the cost by selling the $22 puts for $1. So overall, we spent like 7 cents on this trade. Calculator. So we spent $49.75 minus $2,300 minus $2,500. We spent $175 on a $5,000 spread. All right, that's all we did, and so the return on cash is astronomical, and so it's already doing very well just by virtue of having not gone down so far. It's doing very well. But this is nothing. This is only. It's funny because we're up minus 700, so that's 425 plus 150, 525, 575. So we're at 575, or we have $575 gain so far on the spread. But that's only on track because we got a 5,000. In fact, frankly, if you can get that price and only pay net 575 for the trade, or I'm sorry, 575 plus our original. So about 600. If you can still get this trade and pay net 600 for it, it's still a good trade because we have incredible faith that this thing is going to return $5,000 off of 600. The only reason it doesn't sound exciting is because we only paid $125 for it. That's what makes it sound not that exciting. But the reality is, it's a fantastic trade still to get into. We're just so spoiled because we have these stunning returns when we have good timing on a trade. But even though your timing is terrible compared to ours, all you did is, it's really just that silly percentage you're not going to make. Because now it's 205 minus 120 minus 55. Now it's just 30 cents. We got in 7 cents, so it seems bad that you're paying 30 cents, but the net of the trade is still $2 when it comes in. Okay, so I hardly endorse this trade exactly as it stands right now. It's actually much safer looking now than it was when we entered it. And it's going to return, for every 30 cents you put in, it returns $2. And your only downside is owning DBA for a net of 22 plus the 30 cents that you put in, so 22.30. So if you don't mind owning $22,300 worth of DBA, if you don't mind owning $22,300 worth of DBA, you just get yourself, you sell yourself 10 contracts, you take a 10 contract spread, and you will make $5,000. Oh yeah, this makes a lot more than $5,000. No, it doesn't. I'm sorry. Stop. Two. If you make $2,000, all right, the cash return is $2,000 back on a $3,000 investment, on a $300 investment. I mean, it's an incredible way to play stocks, and it blows my mind when people want to do other stuff, because I'm like, why? We just had that discussion with someone else today, because somebody said they got out of, no, they got TZA assigned to them, and he's like, well, I want to play the stock, TZA. And I said, why would you do that, though? It's like, go back into the spread. That's why you made the money in the first place. The reason you're happy is because you sell premium. You sell premium, you're going to be happy. If you don't sell premium, you're not going to be happy. If you get assigned, in other words, we got assigned DBA because somebody, for some reason, assigned us a 22 put. I wouldn't then say, oh, I'm going to own DBA for 22. Why would I? I can do this instead. I make much more money doing this per dollar at work than I'm going to make by owning the stock. There's really, if the stock's not paying you a dividend, there's really no reason to own it. There simply isn't. Unless the only reason is if there's some kind of incredible call, if the call premium is so high that it makes sense to own the stock or something, or sometimes the stock is so cheap, like a dollar stock, there's no reason not to own it. But I mean, the power of a position like this, where we're up 23 cents, I said we're up 300% on cash on this position, and it's nothing. It's nothing because it's still going to make 10 times, I don't know, like 10 times more money. It's just, it's this incredible thing when you have a position like this, and they're so, you got to look for them, but when you find them, you got to pull the trigger. You got to say, hey, this is a good bottom to bet off of. All right. Questions? I have some USO July 20 calls. What do you think about a July 4th pop? Well, we do think so, obviously, with oil. That we expected better out of oil. It's been disappointing. Oh, look at gasoline is still gathering steam. We are expecting oil. Let's take a look at it. We can get off the Nikkei because we don't expect them to do anything. Oh, it already is popping. I expect oil to be over 60. I expect gasoline to be 210. I mean, really here, 205. In fact, here's 205. So we could go long here. I'm just going to be very pissed if it goes below 205. Or I'll tell you what. All right. We'll do this. I'll buy. Oh, no, that's a short. Stop. Oh, God. So used to selling things. All right. We can buy a long here. Fine. Now, put my stop. No, I tell you what. Okay, here's what we'll do. We're at 205 with 1. If it gets to 204, I don't mind doubling down. I don't even mind tripling down at 204. So if we get to 204, I'll add some because I really do have faith in going to 210 by the weekend. The only thing that can derail this is something bad happening on the inventories. But I think to me, if the inventories are bad, if there's a build in gasoline stocks or something like that, even if the inventories are bad, I think that it'll pop back up anyway, just because it's going to be manipulated higher into the weekend. The same goes for oil. So, we can pick one up here, 59 with the same logic. And I expect to get to 60. By hook or by crook, they're going to push the prices up so that they make some more money. And if it goes a bit lower, I don't mind adding. All right, but I would certainly be out of these trades by close of business Thursday, even if it's losing money, because frankly, that's it. If we don't have, just because the vagaries of the weekend, it's going to be tricky. If we don't have a good amount of driving reported over the weekend, then that's it. Where's the demand going to come from? It's going to be a huge problem. So, I mean, if they can't show a nice amount of volume of demand over the holiday weekend for gasoline and oil, they're going to plunge because this is what everybody's hoping for. And all they can do is get to these crappy prices. This is like, I mean, gas last year was like $2.75. You know, we're way, way below. It's, 20-something% below where we were last year. Oil, I don't know what oil was, but oil was, I don't even want to say what it was. I can't think of the number, but I'm pretty sure it was like 90, 80 something at least. Oh, wow. No, we were still at 100, yeah. Well, we're talking about July 4th. Yeah, we were still at $100 last year. So, I mean, this is beyond pathetic. And look what's happening. We're getting rejected at the falling 200-day moving average. See that? That 200-day moving average, we got up to it and coming in like that weekly and rejected. That's not good. And as you see here, we're coming along the 50. We're actually consolidating here, triangle squeezy thing, and then boom. Don't forget, this is harder resistance. This is, see, you can kind of see these things coming. This is harder resistance. This is why we stopped being long on oil, because you see this is going to be more resistance than that, right? So when push comes to shove, it's easier for oil to go down. If it's going to get forced in a triangle squeezy thing, it's going to get forced to make a decision, right? So it's going to dip between them, and eventually it's going to break one way or the other. It's easier to break a 50-day moving average than a 200-day moving average. Also, you got to compare the angle of them. So in other words, you have a 50-day moving average that's coming up equally sharp or at an equal angle to this. Therefore, since the angles are the same, the strength of the 200-day moving average is going to trump the strength of the 50-day moving average. The 200-day moving average is, by definition, 4 times stronger than the 50-day moving average. Just the fact of the statistical math of the thing, it's 4 times stronger. You've got 4 times more of a trend in the 200-day moving average than the 50. So the 200-day moving average is much stronger than the 50-day moving average. Not only that, though, but the angle of the 50-day moving average is decreasing. See how it's kind of curving down over here? It's not doing well. So you can see the 50-day is kind of following a trend where it's probably going to curve down and follow the 200. So you're not going to get a life cross, the opposite of a depth cross. You're not going to get a life cross where the 50 goes over the 200. What you're going to get is the 50 is going to be rejected by the 200, probably right about here, because we're going to get a little bit of a pop into July 4th, but it won't be enough to lift the 50. The 200 is going to come down here, and this whole thing is going to collapse, and we'll be back down here in the fall. All right? I shouldn't tell you these things so far in advance, but that's what's going to happen. I'm only allowed to tell you a certain amount in advance, so otherwise they take away my time machine. Let's see. What is this? Oh, I see. Okay. So Pat says DBA is one of my inflation factors. Right, I knew I wrote that up at the beginning of the year. Thanks. USDA. I don't like this thing as much because I can't. It's so hard to track where I am in comments. China bought Greece link. Yeah, something happened over there, right? Tal says I have some USA. So what are we? Oh, we talked about the July thing. Good, we caught up on that. Are you calling for ES to go down to 2035? Yes, I am. I think that's where we need to consolidate. Let's take a look at that one. Also a valuable conversation. Ooh, I know what we can do. This will be fun. Oh, no, I don't have it on this computer. Do I? Oh, yeah, it says welcome, Philip. Okay, yes, I should be able to do this then. SPX. Let's see. Because I paid for the subscription of these guys. So that means I can do fun stuff. You guys see me do this sometimes. So let's take the U, and we're going to, well, let's see if we can play with the range or anything. I'm not good at it, but I can do stuff. I'm so not a chart guy. Something about the time, period, weekly. Here we go, monthly. Thank you. Let's see how that looks. Is that going to mean like many years? Oh, nice. Wow, look at that. Okay. So now we're going to annotate this with Java or Flash. I guess it's only on my computer. Actually, it might matter. It might mess up the other thing. Okay. All right. So where are we? So here's this. Like the Nikkei, we have this incredible run-up in the S&P. 800 is the base, and that goes back to like 1901. Okay, so the base here is the base is 800. When we started charting the our lines, this is where we based off of back in 2009 or in 2008 when we were talking about. We actually started doing when we were trying to figure out how low the market could go. We decided 800 was where we wanted to call a bottom. So we started doing a lot of buying here, and even though it went lower here, we still kept buying because we thought this was great. On this day here, when we actually hit 666, I happened to be on TV, and I was like screaming at people to just buy everything. I'm like, ignore this. I was just like sitting there. We were in the studio. It's so funny. We were on TV from, I think it was like 1 o'clock until the market closed. I think we were, I was supposed to do a 1-hour show, and we just kept going because it was people were dialing in and everything, and it was just chaos. It was really fun, though. We had a great time. But I was just like, I'm screaming into the camera. I'm like, oh my God, look at these prices. I'm like, oh my God, look at the price of that. Look at the price of that. Look at the price of that. There were so many things that we picked that all were spectacular winners, of course, because of the way the market came back up. But it was exactly this, though. The thing is, we charted this in the calmer time in member chat, though, we were charting this. We expected exactly this. From 800, ignore the spike. That doesn't matter. We came down from failing 1600 to 800. We went a bit below, but the bit below isn't important. 800 is where we ended up consolidating. We came at 800. That means we're going to bounce to 1200, from 1600 to 800, and then we expected to bounce to 12, 50% bounce. Okay? Then we got to pull back to 1,000, all expected, all perfectly expected stuff. Then we run up again. We go almost to 1,400, back to 1,200, but actually failed 1,200. This was a little bit scary, but we held this 200-day moving average. Then from 1,200, so now 1,200 becomes our new base. All right, this is when we recalculated the big chart was back here, because 1,200 it wasn't really a recalculation so much as we moved the goalposts because we felt comfortable here. Now we had a good test of 1,200. We felt comfortable that 1,200 was the right base for the S&P. Therefore, 1,800 became the new must-hold line. It actually turns out to be 1850 because of the dollar and some other calculations we made. So we really ended up calling it 1850. But in a broader sense, 1800 was the must-hold line. All right? So we get a move from 12 to 18. We've never had a pullback, though. That's what's weird about this run. We had good consolidation at 12. We moved to 18, which is perfectly exactly what we expected to happen. But what we've done now since then, though, because 12 to 18 is 600 points, we've overshot by more than by 50% to the 2,100. We've overshot our goal by 50%. And there is no way, we had a little consolidation here at 1,800. There is no way we're going to do this without a pullback. Now, we did have a pullback. We had a very flashy pullback here to 1,820, but that hardly counts. It's a spike. We don't count spikes in doing these projections. So from 1,800 to 2,100, this whole thing is screaming need for correction. So on the very least, off a 300-point run, we should see a 60-point drop. All right. So and how much is 60 points off of 2,100? 60 points off of 2,100 takes you back to 2,140, which, because of the adjustments, turns out to be 2,135. So, but on the bigger picture, we really need to see a pullback of the run from 12 to 2,100, which is 900 points. We should have at least 180 pullback here. That's going to take you to 1920. And 1920 is right about on the big chart. I think it's 1942. 1920 is right about the 5% line, and 1850 is the must-hold line. So I absolutely down the road expect to see 1950 tested. It would be nice. It's good time, and be a good time to test it now. from a healthy chart standpoint. If we could test it now and hold the 200-day moving average when it catches up to 1850, so over the course of how long will it take this to go up to 1942? It's going to take about, well, let's see, this is 1750, 1600, right? But these are months. This is a long period of time. So here we got 150 points here, it's 1750. So to get to 1940, it's not this long. Actually, it's about this long. So whatever this is here's the beginning of 2015. So basically until the end of the year. So between now and the end of the year, I'd like to see the S&P come down slowly to 1950, 1940, which is that 5% line. By that time, we should be good for a nice consolidation here, and then if it comes off the 200-day moving average and starts moving up, then I could be very, very happy going long again. Until we get a test down here of this moving average, I'm not going to be very happy that we've gotten a healthy pullback. The volume has been consistently down, and it's just not that strong. Let's see if we can do a Fibonacci thingy here. Here's a Fibonacci toy, and we'll look at it from 800 on up. Oh, I did it the wrong way, sorry. We'll look at it from 2100 down. I have 100% to be the top one. Okay. So, there you go. So you can see how well that fits in the Fibonacci series also, because here's 2100. Here's the range that we're looking at down here. And this is from the 800, though. So you can see what happened. You have this consolidation zone sort of in this range here. If we move it back up to 12, though, all right, let's stretch the, oh, what'd I do? Yikes. Oh, here it is. Okay. So if we keep this line at 12 to 2100, you can see what's going on, right? So we have this, see how it jitters into this zone, consolidates on that line, comes up, retests it, and pops back over. So now we look at the run from 1800, and it's hard to do on this chart because it's so tight, but now you look at the run from 1800 to 2100, and you see the same pattern again. It went up, it jitters in this zone, consolidates a bit, and then it comes up. But we're staying here. This is not breaking out, okay? Because what it's going to do is it's going to start coming back down here and retesting in this zone. So this zone is going to be very important. So now, whoops. So now we'll look at that on the other chart. Okay. So now we can look at that on this chart, and we'll do the same thing. This is the daily chart, and we'll take the same tool, and we'll take the same line, 2100, and we'll drop all the way. I don't think I can go to 18. Oh, that's annoying. Oh, wait, I could. This is a very theoretical thing now. Okay. That's not going to tell you anything. Damn it. All right, let's try 1940. 1942.50 is the midpoint. You're not going to get it. See, now we're too close on time. It should have been weekly or something. Like I said, just so you don't get confused, or I'm sure you already are, 1942.50 is our 5% line. So this is half of the series that we're looking for. And you see what we have here, though? This section, this is what you have. These are a couple of times we popped out, but the reality is we're in this little zone here. All right, and this is probably going to end up being the top, and we're probably going to break back down this way. So when we get below 2,000, well, obviously, it's funny when you see it because, well, of course, when we get below 2,000, it's going to crash down. So we're going to test 2035 is up here, is right in here. We're probably going to break here. Once we break the 200-day moving average, you know you're heading lower. We're going to break the 200-day moving average here. We're going to come down to 203.5. That's probably not going to hold. It may get some consolidation because you have this area here is going to get a lot of zigzags. But we'll get some consolidation, but probably we're going to fail down 2,000. If we fail that, we're going to quickly go to 1942.50, and then below that, we're looking all the way back down to 1850 as a possible pullback. That would only happen though if if everything starts falling apart, like if Greece goes bad and if China goes bad and Japan has problems. If all the actual problems start presenting themselves, then you might start seeing that. I wouldn't be betting on it, but I'm just saying I'm certainly cautious that it could happen because we've never had a proper consolidation. That's why. When you look at it in the bigger picture, there's just never been we've never pulled back and tested any of these lines. We just keep going higher and higher. And it's not much different than what happened in China. They went up 100 and we went up 150% too. We just did it over a little bit of a longer time, but we did the same thing as China. We didn't pull back. We never test anything. That's how come you drop 30% in a shot. That's why China drops 20. China's market is just doing what we're doing, but they're doing it on speed. They went up way too far. Now they're pulling back, so they went up 150%. Now they pulled back 25% very, very quickly. But very, very quickly, we did it over the course of 5 years. So they did it over the course of a year and a half. So in other words, they're doing it 3 times faster than we did. So what they did in 2 weeks is what we'll do in like 6 weeks or 2 months or something like that. It's a different time scale, but it's the same concept. You still can't have a market that constantly goes up if nobody's really buying the shares that underlie it. When a market goes up that rapidly, there's very few of the actual shares that transacted at that price. And I was talking about Uber today. Uber now has at last count, Uber had a $40 billion valuation. Nobody gave Uber $40 billion. Uber, as far as people actually taking money out of their pockets, I'd be surprised if even $1 billion has been given to Uber. So in other words, on a $40 billion valuation, that means out of 40 shares, only 1 share has actually been traded. So that's 2.5% of the shares have actually been traded. And based on that, they're trying to tell you that the whole company, that all the other 97.5% of the shares are worth $40 billion. That's not true. Okay, I can find, I can go on the street and find 10 idiots out of 1,000 who will give me too much money for something. That doesn't mean the other 990 idiots are going to give me money, right? Or the non-idiots. You say, oh, well, they're not idiots. They're intelligent investors. They're venture funds and blah, blah, blah. They're not. They're all chasing everything. They throw money into, they talk about Uber, which frankly, and also Uber is losing more money than it takes in revenues. Uber's lost $470 million on $415 million in revenue. These venture guys in Silicon Valley, they put their money into dozens and dozens of projects every year. And one of them is a hit. And they'll talk about that one as if it's like they knew it all along and blah, blah, blah. And they sweep all their failures under the rug with one success. And you can do that because the one success, the guys only gave Uber, the guys who have $1 billion worth of Uber stock didn't give Uber $1 billion. They probably gave Uber $100 million. And everything else is leverage and debt and all that crap. So they give Uber, so these guys already are up on paper, they're up 10 times on their investment. That papers over all of their losses. All right? But if these venture funds were so great, where are the guys who are giving you 200, 300% returns in these venture funds? If they're so smart, and if all these .com companies they invest in are so great, and all this social media is so fantastic, then where's their freaking returns? All right, you know for a fact the guy had Uber. He's telling you how great his Uber investment is, so you know he made 100 times on Uber. That means the rest of his investments had to suck. Otherwise, his returns would be 1,000% for his investors. But they're not. It's just one thing that luckily went right out of all the stupid things he tried. All right, that's like me playing every number on a roulette wheel. And I get them and I get the money back, okay? Because if you play all 36 numbers, One of them is going to hit, and you're going to get 35 to 1 back, right, on your 36. I lost one, right? I lost one unit, but I've got the one winner to talk about. So even though my fund is break even or maybe losing money, I at least have the one thing to show you that made 35 times my investment. And I'm going to tell you what a genius I was for picking 17 black. And I'm going to run around with my 17 black, and I'm going to wear it like a badge everywhere I go and say, I'm a 17 black investor. I knew that. I made that call. That's what the game is out there. That's what all this bullshit is, and that's what they get you to follow. When you start following these stupid stocks and dreaming of how rich you're going to be and blah, blah, blah. It's a freaking roulette game. It's not the way you invest. Anyway, what was the question? I lost track. All right, we're talking about SPY, I think, right? So anyway, so the broader point, though, is the market is full of crap like this, okay? There's so many stocks that are so overplayed because people are chasing things that just aren't realistic. And there will be a reckoning. There will. There always is. This time is not going to be different. All right, Meeting Burner disconnected me 3 times. Oh, Chrissy, that's not cool. I don't know why that happened. Sorry. You posted something today about SSO and you figured out a percentage profit potential. How do you figure out when you construct the spread? What? How do I figure out the profit potential? It's like that DBA. I mean, what's the profit potential? It's $1. Well, I don't calculate it. It's $1. Or actually, I tell you what, the spread was $1.07 on a $2 spread. So how much money can you make? You can make 93 cents divided by 107 that I spent. 86% profit potential, 87% profit potential on the spread. That's it. All right, your percentage profit potential is how much money you can make versus how much you spend on the spread. Now, we mitigated that spread, though, because what happened is because we, it was $1.07, but then we sold the other thing for $1. We sold the short puts for $1. So then our net becomes 7. So then if you're going to look at your potential on cash, you're only putting in 7 cents, and you're dividing that by the $1.93 you can make. What? Oh, no, I'm sorry. Is that backwards? Because it's profit. 193 profit divided by the 7 cents you put in is 2,757% profit potential because we sold the put. So the profit potential goes up from the 86% that it would be if you just took the bull call spread. And 86% is not bad. You know, there's no margin, so it's nice. But if you're willing to take on the margin and risk owning DBA, then your return on cash goes from 86% to 2,700%. So it goes up like, I don't know, why don't I know that? 275. No, because 2,750. It goes up a lot. I don't know what the number is. All right, divided by, I guess I could go divided by 0.86. 32 times. Okay, there you go. That's why it's hard. So you increase your potential return on cash by 32 times. That's a big deal, obviously. So to me, it's like, well, why wouldn't I sell the put if I'm increasing my return on cash 32 times? It means that basically I can put a lot less margin in play and less cash in play to make a much bigger return. But honestly, it's an important point for people with portfolio margin accounts and stuff like that. We always talk about selling the short puts because obviously most of us have pretty big accounts and we don't mind. As a fallback position, if DBA got cheap, I don't mind owning it for the long term. But there's nothing wrong with just taking the bull call spread. You know, we're not taking the bull call spread because we don't believe in the trade. So we like that bull call spread, and the return on that just by itself is 86%. 86%, especially if you're in an IRA where you're not allowed to sell short puts or something like that. What the hell is wrong with making 86% in an IRA? That's a great return. All right. I mean, frankly, I prefer to make 2,700% and pay my taxes, but that's just me. I just find it better to make a lot more money and pay the tax than to have no tax and make less money. My prejudice against IRAs. Let's see. Chrissy says, I thought you prefer to sell premium. I have absolutely no idea how you cannot see that that's selling premium. Al says, is there an ETF for gasoline so I can bet it can pop before July 4th? I don't actually know if there is one. I don't. If anybody knows, please say so. But I don't know. I don't think there is a gasoline ETF that I know of. RB, what? Oh yes. Look, see, I'm making some money. Fantastic. Oh, you guys. Where else do you get a seminar where live we're making? Here's 281 here and 150. So how much is that? That's 330 something. How's that? Very nice, huh? $330 while you're waiting. And we're not even charging you for the seminar, are we? It's fantastic. Greg is working on it. Now that we have it down, we're going to start charging. All right, now, this is me. I take my money. This is a good pop, and I'm happy with it. I'm going to sell if I can. And that goes for oil, too. Oh, because, frankly, I'm not watching this stupid thing, so why would I keep it? There you go. Boom. All right, so, now it disappeared. I don't know how much I made. Well, it was like $250. So now I just added to my total. But that's it. So that's all you do. You put your money in, you get a nice pop, you get out, you got your profit, you walk away. End of story. So now I know everybody's like, when would you get back in? I'll get back in when it pulls back and consolidates again. I still think it's going to 210, but I don't mind if I make, $250, $500 at a time on the way up instead of trying to make one great big one. I'm actually happier like this. I like to pick my spots. I like to find it when it gets a pullback. It's only 2 o'clock actually. I mean, who knows? We might get a sell off into the closing NYMEX, or it might zoom up into the closing NYMEX. But one way or another, they're going to want to drive the price of oil and gasoline up. All right. So who said that? I want to thank whoever said that because they were perfect on their timing. Because that was a good exit. Oh, that was really savvy. Very good. For whatever reason, you said 205. It just reminded me I should look at my thing. When do RB futures close this week? RB futures don't. Oh, well, I don't know what you mean by close. They don't roll over. These contracts are good until like late in August. These contracts are going to keep going. The futures close every day at 6 o'clock. They reopen. Not 6 o'clock. Like 5 o'clock. I think they close from like 5 to 6 or something like that. They stop trading. Very thin trading overnight, and of course on July 4th or July 3rd, I'm pretty sure nobody's trading July 4th. I don't know. In no way, shape, or form would I want to be in these futures over the holiday. Oh, unless we had a ridiculous sell-off. If something happens tomorrow, and for some reason gasoline plunges back to $2, I am absolutely going to buy more. And if it goes down lower, I'm going to buy more, and I'd hold it over the weekend. That's the only circumstance in which I would do it. If I had an entry below $2, a net entry, into the weekend, even if everybody was down on gas, I would still go for it, because my assumption would be that even though you had a build in gasoline stocks tomorrow at the inventory report, that over the holiday, the demand will pick up and there'll be a drawdown next week. So if there's not a drawdown this week, there should be one next week. Because the gas stations at some point have to decide whether they're going to have the tanker trucks come before the weekend or after. Last holiday weekend was very disappointing as far as demand went. I don't think this one will be. I think July 4th is a different kind of weekend than Memorial Day. It's not as optional for people to do something, like especially when July 4th is a Saturday. People are going to go places and do stuff, I think. It's a different kind of weekend. We have Friday off. Everybody likes to have these Friday holidays off. So in other words, you have Friday off and July 4th is a holiday. And I'm going to Disney myself. I mean, we're going somewhere. I think a lot of people are going to say, hey, we can get in a car, go somewhere, and be at this place for July 4th. It's a good reason to take a break and go take a weekend somewhere. So I think there'll be a lot more driving this weekend than there was the last one. Silver, 1550. Absolutely, I love silver at 1550. Is that one we could start looking at? All right, let's say I lost my interest in oil. SI, I'll buy silver. Oh, so close. Yeah, 1550 is always my line. 1550 is a line where I start having conviction. Again, it's the same kind of thing. If it goes down to 1525, I would buy one, and at 1525, I'd buy another, and at 1500, I'd buy two more. That's the way I would play it. It's very expensive, though. I mean, if you're going to be down, when you're down from 1550 to 1525, it's 25 times 50 is your loss per contract. So 25 times 50 is 1250. and then I would add another one at that price. So then after that, I'm going to lose another 2,500. So I'd be down, by the time I got to 15 on 2 contracts. So following that entry plan, if I buy one at 15.50 and it goes to 15.25, I'm down 12.50. I double down at 15.25. Now I've got 2 contracts. If it goes down to 15, I'm going to be down $3,750 at 15 at the point at which I have to double down again. Now I got 4 contracts, and I'd be losing $5,000 if it drops another quarter. Plus the $3,750 is already in the tank. So, I love silver at 15.50, but it's also because I feel that my chance of making 10,000 is a lot more than my chance of losing 10,000 going the other way. But it's extreme, as you can see, it's extremely volatile. So if you're going to get, if you enter silver at 15.50 and you're going to get stopped out at 15.40, you shouldn't even play. Because look at this. Here's somebody entering at 15.50. Here's 15.40, or close enough anyway. But here's 15.40, then spikes right back up, and let's say this was a 15.50 line. Then went down, goes up, goes back down. You can't play this thing and say I can only afford to lose $200. It's not that kind of contract. It's $50 per penny. It's just gonna rip your face off. All right, no matter which way you bet, it's going to spike up one way or the other very sharply in a way that's going to make you uncomfortable. So you have to go in knowing that's how you're going to play silver. That you're going to sit there and take a tremendous loss possibly before it turns around, and maybe it won't turn around. Maybe you'll lose $10,000. It is not a poor man's game for sure. I got out too early. See, I was wimpy. I took my spikes and I got out. So now we'll see what happens. 206 is where I thought this would fail. I really didn't think it was going to pump right over 206. It was crazy. 59.30, and we'll see how this turns out. All right, next. But like I said, you make $400 like that fast. It's like, take the money. I'm trying to teach you guys good habits. All right, next. Jaber, if you were going to enter new hedges at this point, how would you enter at this point? Okay, well, that's a good question. Back to Yahoo, I think. Nope, where did I put it? Here it is. All right, so GSPC. The hardest part of my job is remembering all the symbols of every different chart, because everybody's got a different way they want you to enter everything. It's really annoying. Then we'll compare the NASDAQ, we'll compare that to the Dow, and we will add in the Russell. Don't care about the NYSE because it doesn't have anything to sell. Okay. Now we're going to look at some time frames. 3 months. Those are pretty much in lockstep, aren't they? 6 months. Ooh, now we got something interesting, right? So for 3 months, everybody's in lockstep. 1 month, the Russell's been ahead. 6 months, the Russell and the NASDAQ have been ahead. Year to date is 6 months. 1 year, clearly the NASDAQ is outperforming. 2 years, NASDAQ outperforming. That's a lot too. That's like 20% outperforming in the NASDAQ. And again, that's all these bubble stocks. Okay, that's all these freaking stocks that people think are going to make $1 bazillion, even though they haven't made a dime yet. And here too. So we got long-term 20% outperformance on the NASDAQ. Now, of course, there is something that justifies the NASDAQ being 20% ahead of everybody else, and that is Apple. So AAPL. And here we're just going to do math. So over the last 70 to 130 is almost 100% in Apple. All right? Apple is 20% of the NASDAQ. Well, this doesn't take it. I don't need to calculate this. Apple's 20% of the NASDAQ. It's up 100%. Therefore, Apple itself is accountable for 20% of the NASDAQ's outperformance. So, where did I put it? There it is. So, I'm not going to short the NASDAQ because it's not, I mean, it does have a lot of bubble stocks and things like that, but it has Apple that justifies most of this gain. So it should be outperforming by 20%. That's exactly this is what the NASDAQ should be doing over the long haul because of Apple. It's got one stock which makes up almost 20% of its value, and especially if you count all the Apple components too. So that one stock is going to continue it outperforming. Now, I think the reason we got out of Apple, though, is because I think this is a fair price for it. $130 is a fair price to Apple. I think that the other parts of the NASDAQ that have gone up in value with Apple, some of them don't deserve it. A lot of them don't deserve it. I think there'll be a correction, and I think Apple will get dragged down for bad reasons because it's going to follow the NASDAQ lower. But I don't want to bet on the NASDAQ going lower because I'm terrified of Apple's earnings report. Apple is, I don't think you can really argue it's the greatest company in the history of industry right now. It makes more money, selling more stuff at better margins, blah, blah, blah. It's firing on every possible cylinder. And it's going to be very hard for them to screw this up. So I don't see any, my worry at Apple is nothing to do, my worry at Apple is that they're going to have a stunning report and it's going to blow out the doors and they're going to go up to $150 and I'm going to miss it. That's my biggest worry with Apple. Other than that, I have no worries about Apple. I would love if they screwed things up because, it happens. I would love if they have a worse than expected quarter for some stupid reason. I can't even imagine how it could happen in this particular quarter. But if something happens, if they disappoint, and if they drop down to $120 or 100, I mean, they're what, 125 now? Yeah, 126. If they fell down to 120 or lower, we're going to get right back and start buying them again. Even though, if the whole market collapses, there's no reason Apple won't go to 100, but if Apple goes to 100, I will buy more. If Apple went to 80, I would buy a lot more. If Apple went to 60, I would sell my house, and I would buy more. So there's nothing that can happen to Apple below 120 that's going to make me upset. It's just going to be more of an opportunity to get heavily invested in Apple. And a few years ago when Apple had a big dip, it became like 20% or 25% of our long-term portfolio, Apple. And frickin' made a fortune, made just $500,000 in the end. But it took a while. But that's exactly what we did. It went lower, we bought more. It went lower, we bought more. And it went lower, and we bought more. And people said, I'm not comfortable with Apple being this much of a portfolio. I'm like, why not? It's like, what other company should be this much of your portfolio? What other sector, anything should be that much of your portfolio? But, so like I said, Apple at 130, a little bit expensive. But anyway, so basically what I'm saying, though, is the NASDAQ is out of contention to the point where let's throw it away. We're not going to short the NASDAQ. We do short the NASDAQ. We have the Qs. But the reason we have those SQQs is because we had a lot of Apple at one point. We don't have it anymore. So those SQQs are really not a necessary hedge for us. And also because we aren't playing tech really high. But so throwing Apple out of contention, we now have 3 indexes that we want to take a look at to see which one's gone away the most. So over time, the Russell, 99.3% over 5 years. Over 2 years, we got the S&P and the Russell of the higher performance. Dow lagging a bit over 2 years. Over 1 year, they're all neck and neck. Over 6 months, the Russell's been outperforming by 5%. Over 3 months, they're all neck and neck. So 3 months, 6 months, a year, and 2 years we're back to the same. So on the whole, the Dow is our underperformer in each section. So if I was going to go long, I'd want to go down. I'd want to go long on the Dow. If I wanted to go long, I wouldn't go long on the Dow. Those are such a stupid index. But I would take some Dow components to go long on, like I don't know, probably Walmart, which is kind of low right now. Caterpillar. I'm actually looking at my charts to get into Caterpillar again, but the macros aren't good. But anyway, so if I was going to go long on an index, I want to go long on the one that's underperforming the others because it'll get dragged up by their better performance if things go well. But for going short, it seems like the Russell is our best bet. Now, all right, so hopefully this helps that you get an idea of why I'm going to say the Russell. Now, next thing, What about the Russell? Why is the Russell outperforming generally? The Russell outperforms because the dollar is strong. If the dollar is strong, that's not good for the S&P or the Dow because they sell probably more than half of their revenues come from overseas. So if more than half of your revenues are coming from places where the currencies are declining, it means that you're getting less money. This is why the yen loves a weak yen, why Toyota and the Japanese stocks love a weak yen. Because when they have a weak yen, when they get a dollar, it's more yen for them. All right. Now, for us, we don't like a strong dollar because when we sell, when our big companies sell something overseas, and they get 100 yen, it's less dollars than it used to be. All right. That's how it works out. So now, what's a Russell company? Russells are generally small caps. They don't do as much business overseas. A lot of them are locally based. They're not extended all over the place. So when they have a strong dollar, they are buying materials from overseas that they're selling more in the U.S. So it's cheaper for them to buy their base materials, and it outweighs the negative effects of the much smaller percentage of their business that tends to be outsourced. Now, it's hard to generalize because 2,000 companies and they do all sorts of things, but generally the smaller cap companies do a lot less business overseas than the average S&P or Dow company. All right, so that's why strong dollar is better for the Russell than it is for the S&P. So now we have to start thinking like, okay, what do we think is going to happen to the dollar going forward? Well, unfortunately for this premise, the dollar will remain strong most likely because obviously in Europe, either Greece falls apart and the euro gets weaker, or the EU bails Greece out, which is kind of a sign of weakness of the euro anyway, and either way it's not good for the euro. Japan is obviously doing everything they can to keep the yen weak. The Swiss over the weekend already intervened to keep their currency weak. They purposely intervened to stop their currency from getting stronger while the euro is falling. Even in one little emergency weekend, they already jumped in and acted because they don't want the Swiss franc getting any stronger. So it's hard for the dollar to get weaker. I think at some point we might see the dollar go to 100, so like 95 now. I think probably about another 5% to gain when the Fed starts tightening. So relatively not a lot of downside, but it's not all about the dollar. It just gives the Russell a bit of an edge going forward, but it's not all about the dollar, and the Russell's already pretty high, and it's been outperforming. So I think that, 2 years was it? No, 1 year. 6 months. Really only 6 months. So since the Russell's already up 5%, I think it's, well, obviously it already did, but I think going with TZA is probably good. But then you have to weigh out also whether or not you yourself have a lot of small caps or a lot of large caps and where your portfolio is going to move on. Now, since we have a lot of large caps in the long-term portfolio, we don't have a lot of small companies. Well, we got AA, Beta, Sotheby's, Broadcom, CMI, Cummings, Coach, Harley, iRobot, Twitter, UNG, USO. What is USO? Oh, that's long. See, we are long on USO. Boeing, Transocean. These are all pretty big companies for the most part. ABX HomeAway. That's interesting. Oh, that's doing terrible. Look at that one. Baker Hughes. This is another. Oh, by the way, it's another great trade. Baker Hughes, I highly endorse. CCJ, CHU. So we have a lot of good-sized companies, not really tiny companies and small caps, and a lot of international players. So we have more of an S&P style portfolio. So we chose to protect it with SDS. Ooh, only 150%. We lost some money. All right. I don't know why we didn't touch anything. SDS, okay. So here's SDS, and that's our primary hedge because it's a short-term hedge. It's in the money, and we're just looking to make dollar for dollar going up on this one. So that's our short-term hedge. Longer-term hedges, we do have, as I mentioned, because we had a lot of Apple, we ended up with these SQQs, but maybe we don't want to keep them. We got to think about this. The thing about the SQQs though is that currently we paid $3.40 for the spread. It's currently $4.60 in the money, yet we're showing a loss because the net of the spread is now $2. So we're showing minus $6,000 when really the spread is ahead. So we're kind of stuck in it, and we're stuck in it because the net of the spread isn't favorable to us. We have to wait for it to expire, and then we'll show a much better profit. Because we should be showing $4.60, obviously $4.60. We're $4.60 in the money. So if we let the thing expire, we'd have $4.60. We're only being credited for $2. So we're being credited for $10,000 net here. We should have a net of $20,000 or something like that. It's a lot more anyway. So in either case, so there should be a lot more money there. Our other one though, we have a TZA, and we have a disproportionate. So see, we've already done what I'm talking about. What I said we should, what I was arriving at the conclusion that you should do, we already did it, because we took the TZAs and we made that a more aggressive spread. Because we went 100 longs and 50 shorts. We have the 7 calls in 2016 in January against the short 17 calls, and that's crazy. If these things are 80 cents, that's a ridiculous price. That makes no sense. How much are these? That's probably just giving us a very bad price that hasn't been traded. TZA. And what was that, January? 17 calls. Yeah, see, it's giving us this 80 price. There's no way anybody would pay 80 for these things. They're really like 50. Well, I don't even know if someone would pay 57, frankly. But it says 57. I obviously no one's going to pay 57 because these went for 56. But anyway, so conceptually, though, I do like that setup as far as protecting the portfolio. You can go with like, if you pick up the 9s, it's a little riskier. Did I do that? All right, I think I would. If you pick up the 9s for $1.80 or $1.85, let's say, and you sell, who can you sell for 85? You can certainly sell the 14s for 85. Okay, that's a $5 spread for $1. Okay, you're only paying 40 cents in premium because you're paying net 10. So now you can offset that premium by selling, if you want to. Well, you don't have to, of course, but you can sell these guys for $1.50, the 7 puts. So think about it. You only have to offset 40 cents of premium. And you're selling these for $1.40. So you could sell 1/4 of those 7 puts, the 2017 7 puts, to offset all the premium from that. And then you're 100% protected all the way up to 14 on TZA. So your net entry of $1 minus 40, 60. Your net 60 cents entry can return you up to $5. It's like 800% return. That's a very, very good way to hedge something. I would go with that one for sure. So it'd be the 9-14 spread in 2016 for $1, and then I would sell the 2017 1/4 the amount of the 2017 puts for $1.50, and that basically nets you in for 60 cents per long. So given all that, that's what I think would be the best current hedge to go for. Meanwhile, how are we doing on oil and gas and stuff like that? Let's see. I was right. Okay. So you got a little spike over, but on the whole, that was the correct exit. I feel good about that. All right. I still think, though, it's very strong, though. I mean, these are obviously, we're over the S2 lines here. So it's looking pretty good. Down. Let's see, back to the questions. Okay. All right, Jim, hope that was helpful. Yeah, 1 p.m. Express left the station. 1 p.m. think it was a while ago. Eddie says, any opinion on XME, the metals? I don't play it, frankly, because it's, I mean, I'd rather pick individual things when they happen. XME's got, you know, it's the kind of thing where you're getting the good and the bad. It's like there's so many bad miners, and metals don't all go the same way, and copper's weak for good reason because of China. So I don't, to me, this is just a mishmash sort of thing that's not worth playing. Here, let me show you guys. Go back to Yahoo. Yahoo's very useful, actually, isn't it? XME. And let's look at what's in it. Holdings. Here you go. So you got, I mean, would you buy this? Would you buy AK Steel? Would you buy Steel Dynamics? Would you buy Core Mining? Would you buy Reliance? Literally steels. U.S. Steel, Allegheny. I like Allegheny, actually. I used to like Allegheny. They got more expensive. Would you buy, do you want Stillwood? Do you want Helica? These are not good stocks. You know, there's a lot of crap in there. It's making, already, it's like 40% of your index is already taken up by stuff that's not very exciting. All right, Newmont's not bad, and Freeport's not bad, but why don't I just buy Newmont and Freeport? Why would I want to drag in all this garbage with it? So that's my answer there. It's like, you know, you want to buy the best of the best. You don't want to buy the conglomerate that makes up these things. Not to mention the fact that I don't follow this ETF, but a lot of these ETFs have terrible fee structures that just chew up your money, and they just go lower and lower and lower over time relative to the components that are in them, because if you're paying for the constant buying and selling of the thing. Look, why do you think people set up an ETF? These brokerage houses set up ETFs, and they don't do it to be nice to you. They do it because what you're doing by giving them, every time you buy the ETF, you're putting money into a trading account that they manage, and the difference is that they get the fees. So that's why they have 25, 30, 40 components in an ETF. They want to trade their asses off, because every time they make a trade, they collect the fee. So you think you're giving them a one-time thing and paying a one-time broker fee to buy XME, but that's not what's happening, because they're taking your money and trading it 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 every freaking day. And they are chewing it up with commissions that go to them. All right, now, so when you buy an ETF, you need to pay attention to what they call the expense ratio. You need to think about whether or not it's a good or bad expense ratio, in addition to looking at all the components. Don't fall into the trap where just because somebody makes an ETF that tracks an index that you should be investing in it. Okay, I mean, over the years, I've gone completely away from ETFs, except for a very few that do that perform a specific function for me. Like, I don't want to specifically bet on any one financial, so I like I like XLF, I like FAS, I like OIH. So I don't know which oil company is going to blow up. All right, but if I want to bet on oil services going up, I like OIH for that purpose. Certain sectors do move very much in lockstep, but and of course for shorting the Dow, for shorting the Russell, and those ETFs, by the way, are generally decent. Okay, those ETFs don't have terrible expenses and don't decay too much. But other ones, it's a very random sort of thing, and you can get killed on them. So be very careful with these sort of things. Don't just pick an ETF because it's an ETF that follows some sector. And you have to think about, like with XME, I mean, you're probably surprised that you're basically buying steel. All these top holdings, I mean, more than half of these are steel companies. So it's not really tracking the metals in general. It's tracking steel companies, and it's got gold miners thrown in there. It's crazy. It's like it's all sorts of things. So I even though I like gold, I like silver, I even like FCX down here. If they're cheap again, I'm pretty sure they're cheap again. No, they're not that cheap. Huh? Well, they're right. So even FCX, I wouldn't mind down here, but that's because FCX is a good company with good management that can, even though copper's really depressed right now and they're not making any money, over time I think they'll make money. We just did something. We just took a position on AA. I like AA. even though they're in a down cycle. I don't mind buying some here and buying more here and buying more here. I don't mind if we end up buying a lot of it. You know, we took a stake over here, and we're looking for like $10 average. I think our short puts bring us to like $10. We like them here. If they go below 10, we're going to like some more around 9 or so. And if they go down by 8 or whatever, I'm going to load up on the thing. I love having that flow at this price. But even though I like them, just because they're stuck in that XME, that doesn't mean I don't think they're going to go down more. All right. Where are we? Out of RB, Savvy, good job. I assume you made some money on that one. Chrissy says, would I sort S at 2960? Wow, there's so many things wrong with that very short sentence. Would we short ES at 2060? No, because 25.5 is where our target. So if that's going to be bouncy, then we're not going to expect a very big move from 2060 to 2055. It's not an opportune time. Here, I would have liked it better, 2065, because we already talked about how that was 2075 is a significant line. We know that, right? That was our strong bounce. 2055 is a weak bounce off of 2035. So, if the question is, do I think it'll go down from here? I do. I think it's going to go down to 2035 at some point. Do I want to ride the ES, though? It's a crazy time because everybody's like, any little rumor can knock the market up and down. So I don't consider it an ideal entry. Do I think it's a good short? Yeah, I think it's a good short for sure. But I don't think it's an ideal short. It's not like I would jump on it right now. As far as I know, I don't have any futures plays open. I think we close them. Chrissy, it's when I see a good setup, then I make a call. So like this morning, it was good. Actually, we played along this morning, didn't we? We caught it. Well, we were early. That's right. It was early in the morning. We called along because I felt that we were going to pop up. Then once we got to the market, though, we thought it was going to sell off because we thought this was a bullshit run in the future. We played for a bullshit run in the futures. We had our bullshit run, and then when the market opened and volume, see the volume? When the volume comes in, you can't support the bullshit run. This is all fake. So when the reality sets in and the market opens, the selling comes back on. All right, and now they're trying to jam it back up into the close. Don't forget, this is close the quarter. Also, that's another reason, by the way, not to do it right now. This is the end of the quarter. We could get a huge pop into the close just based on they want to make things look good. So it's a very dangerous time to make any kind of bet right this minute. All right. And again, I hope that worked out. Let's see. Urban, hey, keep getting kicked off. Audio going out. I don't know why that happens. Greg will take a look and see what he can find out from people. Maybe there's some browsers are better than others, or maybe something else. I don't know. All right, you're welcome, Jim. And Rich says, how do you find out whether GTAT is doing anything from a business perspective? They do not issue quarterly financials. GTAT is a dead company. They're dead. They're just dead. I don't think. As far as finding out, you're just going to have to apply the trades and see what you can find out. You have GTATQ in here. The Q means they're operating under bankruptcy protection, and as you can see, Global News Wire, Edgar, Global News, Benzinger. Oh, Benzinger actually said something here. Global News. Most of it's almost entirely news by press release. Everything here is press releases. So nobody's saying anything about it here. Oh, here's GTAT. GTAT wrote down the value of their furnaces. The last thing they did that anybody reported on was they wrote down the value of their furnaces, which is probably not a good thing. See, they found monthly financial documents somewhere. I don't know where you get them, but statements. Oh, here you go. See, Forbes is great there on top of stuff. There's your December statement. GTAT income statements and balance sheets for 3 months are available on this link. There you go. See, there's a link right here in this Forbes article. 3 months they generate $2.5 million revenue. See, they actually have revenue. Isn't that amazing? But they lost $27 million. That's terrible. Um, income perspective is not much viable company without the Sapphire. Apple basically stole their Sapphire business. I think the only chance GTAT has is if Apple Apple took their Sapphire business, which is their whole company. The only thing that can save GTAT is if Apple figures out what they couldn't figure out, how to make Sapphire, mass produce it at a reasonable cost with without too much of a loss, without too much of a loss of products due to defects. If Apple figures it out, and they think they could, otherwise they wouldn't be wasting their time. But if Apple gets the production process right, then what's going to happen is GTAT essentially is doing a licensing deal, like the kind of, like if you ever watch Shark Tank, what's his face, the evil one, I forget his name, but the guy is always, every time he wants people to do a licensing deal, he always wants to like sell the technology and just collect the money. That's what GTAT will be doing though. If this works out, if Apple actually figures it out, they're going to spend the rest of their time just writing GTAT checks to Sapphire. But what does Apple gain by that? Apple gains by that, they're the only people who have Sapphire. Apple now owns Sapphire Glass, and if they figure out a way to make it work for their screens, they will be the only company with Sapphire Glass. All right, so for them it's incredible. GTAT will be just a company that collects checks out of their entire purpose in life. So we'll see. All right, but here's the bottom line: shareholders' equity is negative $241 million. So they need a lot of checks before anything is fixed. And so all you have here is, if you own GTAT, it's just a long-term call option on the possibility that their licensing gets picked up. That's all it is. The company otherwise complete disaster. And here you go, GTA. In fact, there's Forbes telling you what it is. GTAQ probably heading to zero. It's a dead company. It's our worst trade of last year, GTAQ. And we still have the stupid things. And again, just we have it. It's a lottery ticket at this point. It's not a company. There's nothing you should expect to gain out of this. If you want to take a better gamble, LQMT is much more interesting. Apple just renewed the license with them. Hopefully, Liquid Metal is not as stupid as GTAT though and holds on to their stuff. Apple just extended their partnership for a year, which they've done every year for like the last 5 years. In this particular case, though, Apple has a license to exclusively use it for electronic products, but there's still a lot of other applications that Liquid Metal can come up with. But again, they're in the same boat as GTAT in that they can't mass produce it. It's too difficult. The production process isn't there, and so on and so forth. You're betting on the material of the future. It's like investing in, if one of these guys hits, it's going to be gigantic because it's a brand new material that's better than the materials that are being used today, and if they can figure out how to do it, it'll be huge. It'll be everywhere and everything, and you'll feel like the greatest. You'll feel it's like the Silicon Valley guys who make a hit. You'll be like, I invested in Liquid Metal when it was 12 cents, and people will be like, oh my God, it's like $120 now. But that's only if they get it right. But the thing is, you have to understand that you could have said that about aluminum in 1820, and they didn't get it ready. It wasn't able to be produced for production until the mid-1900s. All right, so these things are not, everybody is very, very impatient, and they don't think about their investments as long-term things. It's like, for me, I'm just happy that Liquid Metal is viable. Every year they survive, I'm happy, because they need many, many years before they're going to be able to do anything. This isn't biotech. This is physics. They've got both the same thing with Liquid Metal, the same thing with GTAT. Making a new kind of glass that's never been made before, making a new kind of metal that's never been made before. These aren't the kind of things that you go and run a couple of tests and start pushing it out there. This is light. These are game-changing things. Remember, we had the Bronze Age, and then we had the Iron Age. Okay, and then we had steel. These were hundreds of years between the new materials coming out. Now we've got it down to maybe 100 years or 50 years or whatever. Now we've got like a much shorter time frame. But if you stare at these things and say, why didn't it move this week, or why isn't anything happening, forget it. You shouldn't be in these trades. Okay, these are not that kind of trades. These are trades that, like, over the course of your lifetime, hopefully, these companies will actually be able to commercialize what they have before their patents and whatever expire and other people figure it out or something. Or before somebody else comes up with a better process doing something else. But, these are the alchemists of our age, and you really can't expect anything of them other than exactly what they're doing, which is surviving and getting somebody like Apple to give them some more money so they can do some more experiments every year. And one day somebody will hopefully go eureka, and liquid metal will be everywhere all of a sudden, like the Terminator. The start of a new and amazing age of killer robots. But and same thing for glass. I mean, the sapphire, it's unbreakable glass that can be on a screen and super thin and blah blah blah. It's like, yeah, well, you know what? It doesn't exist. In theory, it exists. They can make it, but they can only make it in little teeny tiny pieces. They can't make big ones. They can't make ones that's big enough to be your smartphone in any kind of quantity. So therefore, it's useless. It's great in theory, useless in practice. It may remain useless for 10 years or 20 years or 30 years or 40 years, or it may have a breakthrough next week. But don't expect the breakthrough, because more likely 20 years from now, you're going to turn this useless stock over to your kids, if it survives, and be like, here you go, hopefully it'll work for you. That's the short story on those guys. Oh, we're over time on our meeting. What do you know? Eon trades. That's right, Pat. Eon trades. All right. Well, I guess that's about it. It's 2:40. The NYMEX close. So let's see how we see. We did get a little bit of a sell-off into the NYMEX close. We're below 205 now. I'm not. I really would. At 204, I'll start buying again. I'm not into it at 205. Oil, I could care less, frankly. I'm not really tracking oil. I like it over at 59, 58.50 for sure. I like it. Going into the weekend, not owning it into the weekend, but going into Thursday basically. But at 58.50, I like it. We have the API report coming out tonight, though. So if you see a big spike down, it's going to mean there's going to be a disappointing API report. That's exactly what I'm going to start getting interested in, though. If we get a spike down to 202, I'll be excited. If we get a spike down to 58.50, I'll be excited, although I'm going to want to find that API report first. But if it happens, I'll check in and chat later if there's anything exciting happening. Usually about 6, 7, 8 o'clock, you get the API report. The problem is it's a very private report. You have to wait until some reporter actually prints something about it, because not everybody gets it. All right? And that's it. So thank you all very much for coming, and we will obviously reconvene next week. Oh, no, we won't. I'm sorry. Yeah. It's iffy. I'm going to be in Disney next week, and I'm not going to want to do I'm sorry. I got my kids. I got things to do. I'm not even sure. I'm not even positive on Tuesday I'll be present. But I will say this. If there's a crisis in Greece is still going on, if the markets are in turmoil, then it's more likely I'll do a webinar, okay? But we'll play it by ear on Tuesday. But my plan is right now not to, because I'm on vacation. Right? So next week, probably no webinar. I will be, of course, working. I'll check in. I'll be on semi-work vacation, so I'll be in and out of the hotel and doing stuff. But I'll definitely chat the same way I do when I go on vacation in Vegas or something like that. I'll be often at the computer, but just not full time all day long. All right, there'll be like probably 1 day or 2 days I'll take off next week out of the 5. But again, the more of a crisis there is, it's like I'm not going to the park, and I'm going to tell my kids go deal with your own stuff if there's like incredible turmoil, which there may be next week, because who knows what's going to happen over the weekend with Greece. So if there's a lot of turmoil on Tuesday, I may actually decide to do the webinar. And again, I haven't done the webinar from the road, so God knows what kind of technical difficulties we'd have. But if the market's bad, then maybe we'll do the webinar. And if it's not, though, if things are calm, we're going to skip next week and we'll do it the week after, okay? So everybody have a fantastic July 4th holiday. Enjoy yourselves, and I will talk to you in 2 weeks then as far as the webinar goes, okay? And we'll head back to chat. Thanks.